Good morning, good afternoon, everyone. This is Rob Barnett. I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in energy markets. On the call today, we've got Salih Yilmaz joining from his perch in Dubai, then swinging across the ocean here in New York today. We've got Will Hares, normally joins from London. We've got Scott Levine in 731 Lexington. That's where I'm at as well. And Vince Piazza is joining us via Zoom, although he is coming to the office today. And just a quick advertisement, if you haven't registered already to join us, we do have an in-person roundtable tomorrow here in New York. Sally's not joining, but the rest of the group here will be there, as well as a few other members of the team. So we look forward to seeing everyone who's going to be joining us tomorrow. There's been quite a bit of news in the energy space over the last few weeks. And Vince, I want to come to you first because some of your companies have been particularly in the news. I'm thinking about the uh, Conoco marathon situation. So tell us about what's going on there. I know you had a react out and some follow up content. So what do you make of the deal?
From a financial engineering perspective, I think it's a win-win. Um, you know, Bringing Marathon into the fold actually boosts your free cash flow yield. You can generate roughly 500 million of synergies, and that's very reasonable just given the cost base of Marathon. So I think once you run through those numbers as we have, the 500 million of synergies, probably some upside there. As a sweetener, Conoco boosted its dividend roughly 34%. And they've locked in roughly about 20 billion of share buybacks over the 3 years. And that 20 billion actually exceeds the market cap of Marathon. So it's definitely an enticement for Marathon holders and also for legacy Conoco holders to approve the deal. It's an all stock transaction. I think what I would say here as well, as a note of caution, you do get with marathon stubs of exposure that are not native to Conoco. So bigger isn't always better. We really believe in asset concentration, regional asset concentration, two Permian guys getting together, two Bakken guys getting together, Appalachia, Haynesville concentration in natural gas. So there could be some divestitures along the way post the closing of the deal. You got to think the FTC takes a look at this, guys, just because it is a pretty substantial acquisition in North America, although Marathon does have some exposure, some asset exposure outside the continental US. But this continues the trend that we talked about, right? It continues a trend of consolidation. We were seeing significant consolidation in the key Texas, Permian, Midland, Delaware subbasins. And that's pretty obvious. That is a legacy play. That is a very low cost, highly economic, very prolific play. We're starting to see some inklings on natural gas side too, with Southwestern and Chesapeake, but that's probably going to go through an extended FTC review because of the concentration of natural gas within those two key asset areas, especially the Haynesville with its exposure to seaborne LNG. But the trend continues, using your valuation, your higher valuation, to buy a peer at a discount. So using your currency to take advantage of the valuation arbitrage.
Okay, thanks, Vince. Very interesting. Solly, I want to swing over to you to get your comment on some news out of Saudi Aramco is has also been on the headlines a couple of times over the last few weeks. One, I think, relates to a share sale, and I believe there's also some news about working related to some LNG deals in the U.S. So tell us what you make of what Aramco is up to at the moment.
Sure. So on the secondary share offering, first, they launched a share sale last Sunday. It's going to be about $12 billion. Initial demand seems to be pretty strong, but I think the important part here is still how much foreign interest there will be, because you might remember, for Aramco's IPO about 5 years ago, it was mostly local investors, regional investors that invested in the IPO. Since then, I mean, what has changed? The company obviously has a much bigger focus on dividends. Their dividend yield is now at 6.6%, which is pretty competitive globally. But I mean, their valuation is still pretty hefty compared to the global peers, compared to the Exxons, BPs, Shells of the world. So I think this will be a test. I mean, on Sunday they said just in a couple of hours after the launch, they had enough interest for the offering. They had, I mean, the offering was pretty much oversubscribed. But what I'm watching is, once again, how much foreign interest there will be. And I think the CEO and the team are doing a roadshow in, I believe, Europe and the US this week. And I think by the end of this week, we will know where the offering will be priced. And what I'll be watching once again is how much interest there will be outside of Saudi Arabia and outside of this region. And on LNG, I mean, we know Aramco is not alone in this. Aramco, ADNOC, the NOCs in this region are taking natural gas a lot more seriously. They're trying to produce more non-associated gas themselves, but also they have been acquisitive in buying assets internationally. And they've already, I mean, both ADNOC and Aramco have already made some investments in LNG abroad. But I did also see the news, I think Reuters reported that they are still in talks with some of the US LNG companies to invest a little bit more and increase their gas profile outside of this region as well.
All right. Will, I want to get your reaction on the continued M&A activity that Vince was talking about. And one of the things Vince mentioned is, kind of where valuations are at. And I know we've often gone back and forth on kind of the U.S. oil patch versus where some of the European oil majors are at. So, what do you make? Do you think that any of the European majors will also be looking at M&A, and how do you square the valuation discount over to Europe at the moment?
So the short answer to the first question is yes. I do think that M&A is likely on the horizon for the European large integrateds, but not in the sense that we're seeing over in the US. It would not make any sense whatsoever for BP, Shell, Total to make a big move into the US shale patch. Most of these companies have been doing the exact opposite over the last several years. Including Equinor, which came into the Eagle Ford very late, and there's been overpaying and underperformance for some of these assets from the Europeans. So it's not suited to fitting into their portfolios right now, and certainly not with the ESG scrutiny discrepancy that we're seeing in Europe versus the US. This would not fit well with emissions reduction strategies. But with that being said, the kind of assets that we would see them acquiring are, bolt-on acquisitions, deep water, LNG, continued expansion in the Middle East. So there are areas here where we think the Europeans can add to their portfolios, but not in a large scale context. Multi-billion or tens of billions, as we've seen this wave coming in the U.S. Also, I wouldn't be surprised to see some more energy transition moves as well. But I think it's important here to note that these companies are actually tapping the brakes on their energy transition strategies. They're marginally increasing their oil and gas investment. This is against strengthening demand outlook for global oil over the long term. And we're seeing the management teams sort of dial back the pace of their emissions reduction and slowing their this overall transition pace. And I think that feeds very well into your second question, which is valuation. And this theme has been hit on very heavily in recent quarters from the big Europeans, and it's hard to escape from that. There is a significant valuation gap between Europe and US. We're looking at 3, 4, or 5 times forward PE discrepancy between US and Europe. And the number one priority that we see for management, which is filtering through to their strategic adjustments, is trying to narrow this gap. And we're seeing that A, from the slowing of energy transition pace, B, large buyback and distribution programs, and C, quite interestingly, proposing the idea for a couple of these to move their primary listing from Europe to New York, and of course this would probably be the most meaningful move that they could do as far as valuation is concerned. Energy is viewed very differently in the U.S. In investment landscape than in Europe. It evades much of the ESG pressure that these companies face in Europe. There's a very different investor makeup, and energy is much more welcomed, and there's a higher significantly higher return on average capital employed from the U.S. majors. So while it's interesting that we see management teams talking about this, I ultimately think that it's pretty unlikely to occur. Shell has been the most vocal with this CEO Wael Sawan saying he's seriously considering it, but it would require a supermajority shareholder approval, and so I think that's probably quite unlikely. Total has suggested it as well. I also think that the French government would be pressure them significantly against that, and BP has been the only one that has been pretty unequivocal on its disinterest in pursuing a U.S. listing, but it has talked about closing that valuation gap.
Okay, very interesting. Vince, I think you have a comment you wanted to add here.
It's interesting, the difference in the markets, right? So the U.S. market is much deeper. It's much more diverse. It's much more liquid. So the average investor in the U.S. market has the ability to perform the diversification for him or herself. I can recreate the exposure of an Exxon by buying a refiner, by buying a chemical entity, by buying an upstream franchise. I really don't need Exxon to do that for me. And in fact, if you think about ConocoPhillips and Marathon, they separated their downstream businesses and became standalone upstream entities. And we have a different view here on why that is, and perhaps some of the majors in the European market, there is a social political factor that needs to be considered when we think about these large entities. And perhaps, coming here in the U.S., I'm not sure that the reception would be any different because, we have a very liquid market and we can recreate the exposures that we desire, even with that multiple discount. The multiple discount exists because perhaps it's difficult to try and value an entity with such a diverse asset base. That's just a comment, really.
Yeah, that's exactly right, Vince. I fully agree with that. the one thing I would add is that particularly in Europe as well, you've had these companies that are trying to that are trying to deal with the ESG pressure from investors on one side, and also their traditional oil and gas investors. And so what they've ended up doing is they've ended up trying to placate both, but in the end placating neither. And they're sitting on the fence now with significant lower return renewable assets and suppressed capital allocation into their traditional cash and oil and gas cash engines, whereas investors can just say, listen, if I want oil exposure, I'll go buy an Exxon or a Chevron, and if you want renewable exposure, you can go buy any one of the European utilities with significant renewables. So that's exactly what's happened.
And the one thing I would say, Rob, and this goes into an issue that we're going to be getting into in the second half of the year. We put out a note on the efficacy of buybacks this morning, and we're going to get more and more into that. What tends to happen is there is a knee-jerk reaction by management teams. There is this excess pool of cash flow, and they yield to the pressure of the investor base, a vocal minority that wants to see that capital repatriation in the form of a buyback. And I think over the course of the next few weeks and months, we're going to be talking about how we should be looking at buybacks relative to base and supplemental dividends, using capital for M&A. The note that we have out today, by the way, refers to buybacks as mostly a sunk cost. So I'll leave that there. It's kind of a controversial issue, kind of a controversial topic, and I look forward to having that debate maybe tomorrow and definitely over the next weeks and months.
Fantastic. I love a little bit of tension that seems to exist here. So, Scott, let's bring you into the conversation. So I know you've got a big deep dive out, which I want to get to, but first, let's start with LNG contractor Zachry filing for bankruptcy. I believe they're one of the companies working on Exxon's Golden Pass project, and I wonder if you can give us some sense of is that going to affect the timing?
Yeah, thanks, Rob. So Zachry is one of the 3 contractors working on the project, and yes, that will affect the timing. We've heard rumors of maybe 6 months or so on the impact there, and it remains to be seen what transpires, whether they're replaced on the project or not. Their partners are McDermott and Chiyoda out of Japan, and there's a couple of things that are noteworthy here. Number one, they indicated in the article that we saw regarding a potential filing that it specifically relates to this project and challenges that they've had here. Zachry is also on the Venture Global Plaquemines project, and expectation would be that that would not be affected, perhaps, depending on how things play out here. The Exxon project is a brownfield project, which started out as an import facility over a decade ago and is being now redirected towards exports. And so we put out a note on this last week with Talon, Custer, because there have been cost overruns on other U.S. export projects, and in fact that sent McDermott into bankruptcy in 2020, overruns on Cameron and Freeport. And so remains to be seen what the knock-on implications are, but the one thing we can say is that the list of contractors that have the financial wherewithal to work on these projects is shrinking. And more and more of those, obviously Bechtel's had a lot of success, but a lot of the publicly traded contractors to a much lesser extent. And so we'll see if the terms of these contracts need to change in order to provide more, leniency or leeway, or things need to shift as far as the contracting structures change in order to prevent these types of situations from occurring. The other thing to note is obviously that the Biden administration implemented a halt on export permit approvals. So we could see the pipeline slow in the U.S. Over the next 6 to 12 months. This has been a highly controversial move by the Biden administration. We're in an election year, obviously, and so the situation is still very fluid there. But this news regarding Zachary in particular was surprising, and has increased focus on what seems to be more of a murkier LNG infrastructure project pipeline in the U.S. Over the next couple of years, perhaps.
I love that you highlighted the political angle around LNG. I'll just quick advertisement. Next week on this call, we're going to have Nathan Dean join us. Nathan is our senior analyst based in Washington, D.C. He's got the pulse of what's going on there. So join that conversation next week if you really want to go deep on LNG policy, IRA repeal, anything that could potentially happen if Republicans win the White House and the Congress this fall. Scott, I want to take a few moments here to have you give us some details on this big new report that you've got out. So we are publishing these days what we call deep dives. These are big documents, big PDF, so much longer form than our standard sort of notes that we often put out. Will and Salih put out a deep dive recently on geopolitical risk scenarios for the oil price. So Scott, you've got one on Forever Chemicals. I love the name. So tell us about your report and give us an overview of some of what you've done and what you're thinking about these days.
Sure. So, this is something that affects, predominantly our environmental universe, but is relevant for energy as well. And basically, late last year, we saw the potential for EPA regulations to come out early this year, where we would see contamination limits set for water, drinking water, and the designation of certain PFAS or forever chemicals as hazardous substances. And we got that in April, actually. And so, it's taken us some time to, we built a model. Basically, these are chemicals that are synthetic chemicals that are used in a lot of consumer and industrial products like nonstick cookware and stain-resistant carpeting, fast food packaging, etc. They're valued for their ability to repel oil, water, and grease. And so the regulations, because they have been found to be linked to a number of health issues, and that those findings have proven to be fairly conclusive. We see that kind of jump starting what we expect to be a $300 billion cleanup opportunity over a 20-year period of time. That's a very large number. And so the report that we did kind of breaks down how we see that spending playing out, and both on the water side and on the solid side. We try to break it out in terms of the addressable market opportunity for the environmental industry. We also included involvement from our policy and litigation and ESG analysts, since this is a pervasive issue that's going to impact a variety of sectors, since a variety of consumer products companies use PFAS. And there's more than 15,000 PFAS out there in the environment. And so we see it having a long shelf life in terms of the opportunity in the next few years in particular. Could be very important in terms of companies testing for PFAS, determining how much money they're going to really have to spend in order to comply with this, who's going to pay for it. I know 3M and DuPont have been in the news about multi-billion-dollar legal settlements with the drinking water municipalities, and so that's a fun part of this. But we see much more potentially having to come from increased water bills and waste bills and sewer, and unless we get initial federal funding or additional legal settlements are struck. And so, very large topic. We felt like provided a good opportunity to do one of these deep dive reports. So I think it's going to have a very long shelf life here, and there's a lot of additional policy and legal catalysts to come. So thanks for the opportunity to highlight that. Again, I know it's more of an industrial topic, and I cover both energy and industrial services, but It's an interesting report, and we look forward to talking about it a little bit tomorrow as well.
And you had a specific webinar that you did on that, I believe, and that's available for replay. I
Yes,
believe.
it is.
Okay.
We did that last Wednesday on the 29th when we published the report. So yeah, we can circulate that as well, and folks can go ahead and check that out.
Yeah. So either shoot myself an email or Scott an email. We'll get you the replay if you want to go deep on this topic. Okay, so we've got a little bit of time left. One of the things we haven't gotten to yet, Salih, let's come to you. We did have a OPEC meeting of sorts over the weekend. That was a little bit of a surprise. So tell us what happened and what you make of the discussion there.
Sure. So it was a bit of an odd one because it was supposed to be in Vienna, then it was moved to online. I was actually supposed to go to Vienna, but I had to cancel my flights and my hotel. But then again, last minute, it turned into a hybrid one because they actually did invite some of the press and some of the ministers to Riyadh, not to Vienna. So the headline was that they extended the current output cuts that they have into the third quarter only, and they actually gave an outline now about how they will go about unwinding those cuts. And the extension to the third quarter is actually faster than what we were expecting and clearly what the market was expecting. Our expectation was that they would extend all the way to the end of the year and perhaps not give an outline just yet about what they're going to do next, but they did. And the reaction so far on oil prices has been quite negative. I mean, Brent is down, I think, about 5%. It's below $80 a barrel now. So clearly the market view is that, the economic outlook, the demand outlook is still uncertain, and there is an abundance of supply from outside of the OPEC Plus group. So the market doesn't seem to think there is much room for OPEC Plus to start bringing any of those barrels back before the end of this year. So what this tells me is it's very likely that at some point, and they did say that this is subject to change, at some point at perhaps the monitoring committee meeting in a couple of months, they decide to extend the current cuts into the fourth quarter as well. And very briefly, I want to talk about the kind of how complex these cuts have gotten and the layers that we have right now. So because they kind of announced the first layer and then they announced the second layer and then the third layer. So we still have the first layer that they announced, which was the 2 million barrels per day by all member nations. And that has been extended all the way through. And this layer has now been extended to the end of 2025. So we had a second layer, which was about 1.7 million barrels per day by 9 member nations. And this has also been extended to the end of 2025. So it's the third layer, which was the voluntary output cuts by 8 members. And this is the one that's being extended only to the third quarter. And then from the third quarter, from October to the end of next year, they now have a plan of how they'll bring those barrels back. And perhaps interesting to note also, beyond the tapering of these cuts, the UAE, which is the member country that is producing the most below its capacity, they've been quite vocal about how there needs to be a higher quota given to them, and they actually did secure an increase of their quota level for 2025 by 300,000 barrels per day. So clearly, once again, because this happened a couple of years ago as well, where they secured the higher quota level, the UAE comes out of this meeting as the clear winner. But again, about the oil market, the fact that the UAE will be bringing gradually those 300,000 barrels a day in 2025, and also now that OPEC Plus is showing willingness to start bringing more barrels back in the market. I mean, the traders clearly did not like the sound of that. Yeah, but I mean, in terms of technical levels, Brent apparently has entered an oversold area. So some traders are saying, from here on, it's summer season. Demand should be pretty strong through the next few months. So fundamentally, there is still a pretty good backdrop for oil, but these OPEC news since Sunday have not been received very well by the market.
With our remaining time, I want to quickly swing back over to Vince and Will and get their response on this. And we'll come to you first, Vince. I'm curious, what's your sense on where the U.S. oil patch is at the moment? Are they still in growth mode? Are they simply gonna try to take more market share from OPEC in the year or two ahead?
Well, I will tell you, coming off of the earnings calls this past quarter, discipline is still reigning. Investors want a return on that capital from the first chunk of Shale 1.0. And when we take a look at our space as of this morning, free cash flow yields are running closer to 9% for the upstream group, and free cash flow could actually rise with better pricing on that gas as well. Obviously, associated gas comes from liquids drilling too. But I don't get the sense that there is a desire from either the investor base or the management teams to jerk up production growth. We are seeing DUCs rebuild now. They have come off the bottom and they're starting to rebuild. When you complete a well, 2/3 of that cost is on the completions end, 1/3 on the drilling side. So rebuilding your DUC backlog provides you an opportunity for when prices do improve to complete that well and tie it back into sales within a couple of months. So we don't see growth coming in the second half of the year. We do see better optics for free cash flow yield, but no investor is talking about, or no company is really talking about boosting that production at this point.
Will, we're going to give you sort of the final thought here. What about production growth from the European oil majors? I've seen you talking about this idea that energy transition investment has been slowing, and I think there's been a sort of return to focus a little bit on the traditional side of the business. Does that mean higher productions coming from some of the European energy majors?
Yeah, that's right, Rob. So we've seen the slowing of energy transition pace, which is manifesting primarily in a flattening of production trajectories to 2030 from prior decline. So that's for Shell and BP, and we think we could actually see these being further revised to showing slight growth through the end of the decade. But then I think these companies are still committed to the energy transition. It's just the pace is changing. The trajectory for decline will become more pronounced later on. I think from 2035 to 2040, as renewable capacity and contribution in the portfolio really starts ramping. So it's essentially the energy transition has just been pushed out slightly by 5 years, 5 to 10 years for these companies. And as a result, we will see higher production growth in the interim. But I would just caution that the growth that we're seeing is nowhere close to the growth that the U.S. Heavy hitters are planning. Adding very significant production growth from Guyana for Exxon. And Chevron as well in the Permian. So it is once again on another scale as we talk about Europeans versus US, and there's still a major strategic gap here that although the Europeans are starting to close a little bit, it's only a small moves that are being made so far.
All right, fantastic. Well, I want to thank everyone for their time today. Just a quick friendly reminder again, tomorrow, if you're in New York, come join us in person for our roundtable. Email any one of us, we'll get you the details on that. Next week, make sure to join our conversation with Nathan Dean. And I know we switched platforms this week as well. Previously, we were using WebEx. We've switched over to Zoom. I think that's going to be a better method for this. But if you don't like it, or if this is too difficult to figure out, just let us know if this is your preferred platform for doing something like this. So anyway, look forward to being in touch, and thank you so much for your time today.
Thank you.